So wherever there is a two different markets, whenever there is a different price in two different markets, and I can use this as an opportunity to make profits. Whatever happens, whether the price increases or decreases at some point of time, the price needs to be equal. I'll wait till that moment and then I'll reverse the transactions. And that's where it is. Either I need to reverse or I can go for a physical settlement. So in that case, it is called as arbitrage. So that's where it is. Arbitrages are in business to take the advantage of discrepancy between prices in two different markets. So I gave you one example. So now we have got two different markets. I've got currency market, currency spot, and I've got currency forward or currency derivatives. If there is a big difference between two different markets, buy wherever it is low, sell wherever it is higher. Simultaneous transaction, that's called arbitrage. Similarly, I have a commodity spot market and we have got commodity derivatives market. So whenever there is a big difference between two different markets, buy and sell simultaneously. And this is what your arbitrage is. So if you look at the market participants, so the market participants is going to be hedgers, arbitragers, and speculators. So only these three market participants are there. So now you need to identify who are you. Are you a speculator? Are you a hedger? Are you an arbitrager? So now, so what is the investment size which approximately requires? So since I'm talking about this, let's talk about this also. What is the investment size when it comes to this? Let's say, for example, if I'm planning to be a hedger in gold, let's say, for example, 1 kg contract. So theoretically, I'm holding spot. So I've already invested 47 lakhs or little lower than that if I bought it very well in advance. Now to hedge my position, I need to pay advance money. So only then I can able to manage my risk. So I've already invested about 100% of money, plus I'm investing 20% of money for taking a position in futures market. So here usually you take opposite position in futures or in forward contract. So if you are a buyer here and you sell there, if you are a seller here, you buy there. That's how it works. If you are an importer, you need to buy it in the spot market on 20th of June. Let's say, for example, the same example which I gave you, for which you're going to sell dollar to a other person. So you have to buy it in the forward contracts or in the futures contract. If you are an exporter, you are going to buy dollar in the future date in the spot market, for which you have to sell in futures market today. And that's how it works. As far as speculator is concerned, you don't need assume if the margin is going to be 20%, and you don't need to pay fully, you have to pay only 20%, and you're taking a risk, and your benefit is also going to be higher. You're not paying 100% of the contract value, you are paying only 20%. Whereas as an arbitrager, you buy it in spot, also you sell it in futures. If you do this here, you have to pay 100% at least for 2 days. Here you can sell 20%, you can pay 20% money. Again, your investment is higher in the case of arbitrage. I'll put it this way: hedgers are the people who invest more amount of money and they expect no profits, also no loss, and that's what their motive is. Arbitragers are the people who invest more amount of money and they want only minimum profits, that to be only when there is an opportunity, not always. Speculators are the people who invest less and they expect always profit and they are ready to take risk. So this is what the findings which we can do when it comes to the market participants: hedgers, arbitragers, and speculators.